I want to share a trading philosophy that completely transformed how I read the markets. For years, I struggled with traditional technical analysis, constantly getting stopped out by sudden price movements that felt almost personal. It wasn't until I learned to view price action through the eyes of institutional players that everything clicked. This approach focuses on tracking market efficiency and order delivery, stripping away the overcomplicated jargon so that anyone can look at a chart and actually understand the true story it is telling. You don't need a massive starting account to make this work. You just need to know how order flow operates and where the real capital is moving. Everything I do revolves around a single, crucial concept: liquidity. To put it simply, liquidity is just the digital footprint of pending orders waiting in the market. Think about it this way. The moment you decide to place a buy order at a specific price level, you aren't just trading. You are actively providing liquidity to the market at that exact price. You are essentially telling the market where you are willing to buy. The exact same principle applies when you sell. Because millions of retail traders, massive banks, and financial institutions are constantly placing orders, liquidity exists at every single price point. This constant tug of war between buyers and sellers is what makes the market move every day. It is a continuous process of matching buy orders with sell orders, facilitating transactions across the global network. To understand the market's true nature, you have to realize that price behaves like a vehicle searching for fuel. Liquidity is that fuel. The market will naturally drift or violently target areas where the highest concentration of orders rests, simply because large market participants cannot fill their massive positions without hitting these clusters of buy and sell stops. However, some price levels hold a massive amount of liquidity compared to others, and that's where the trap springs. Imagine you're analyzing a chart on TradingView and you spot a clear support level where the price has already bounced twice. Like most traders who rely purely on basic retail patterns, you expect a third bounce, so you enter a long position right at that support line and tuck your stop loss just underneath it. If you're a bit more cautious, maybe you place it slightly further down to give it some breathing room. I am sure you have experienced what happens next. Instead of bouncing cleanly, the price suddenly slices right through the support level, creating a sharp wick that triggers your stop loss, only to immediately reverse and rocket higher. You are left staring at the screen, wondering why a perfect setup failed. The reality is that professional traders with massive capital intentionally target those exact areas. They know exactly where the retail crowd is looking and where those stop losses are clustered. By driving the price down to trigger those stops, large institutions generate the massive sell volume they need to fill their own large buy positions. Remember, for a multi-million-dollar buy order to get filled, there must be an equal amount of selling volume available. Your stop loss as a buyer is a market sell order, which provides them with the perfect counterparty volume. That is why you constantly see those sharp wicks through key levels right before a massive reversal. I learned how to position myself with the top 1% who take advantage of this behavior, rather than the 99% who get caught in the trap. I've found this approach works beautifully on lower time frames, like the 5 to 15-minute charts, where liquidity hunts happen multiple times a day. You can apply it to almost any asset class, whether you prefer Forex, crypto, or stocks, because the underlying auction mechanics of markets remain exactly the same. To keep my execution flawless, I look at this strategy as a sequence of connected ideas. Each concept builds on the last, meaning if I can't find the first clue, I simply don't move on to the next. My first task on any chart is to identify a break of structure. To do this, I have to map out how the current trend is forming. We know markets move in waves rather than straight lines. In a healthy uptrend, the market creates a structure of higher highs and higher lows. In a downtrend, it establishes lower highs and lower lows. Whenever the price manages to break past a previous high in an uptrend to form a new, higher high, that is my break of structure. In a downtrend, it's when the price breaks below a previous low. When I open my layout on TradingView, I always wait for a candle body to actually close past that previous level. A simple wick poking through doesn't count as a true break for me because wicks often signify rejection rather than a sustained structural shift. Once I have that confirmed break of structure, I move to my next clue, locating the supply or demand zone. These zones represent the exact areas where massive institutional orders were triggered, causing that sharp, explosive move that broke the market structure in the first place. This is where the initial order block or market imbalance was created. To find a demand zone after an upward break, I trace the move back to its starting point, right before the rally. I look for the very last down-closed candle before the sharp upward push and use the rectangle drawing tool on TradingView to map out a zone from that candle's low to its high. If it's a downtrend, I look for the last up-closed candle right before the sharp drop that led to the break of structure, which marks my supply zone. To add an extra layer of confirmation to these zones, I always look for a hidden clue left behind by the algorithms, a fair value gap, or what some call a market imbalance. When smart money injects massive capital into the market, the price moves so rapidly that it creates a three-candle pattern where the wick of the first candle and the wick of the third candle do not meet. This leaves a literal hole in the price action, filled only by a single, large, aggressive candle. On my TradingView charts, I treat these gaps as magnets. An institutional demand zone that sits directly below a fresh fair value gap has a much higher probability of holding up, because the market is fundamentally designed to return and fill those pricing inefficiencies before continuing its true direction. With my zone marked, I look for the most critical element of the entire plan, the liquidity level. I need to find an obvious level, like a double bottom, a triple bottom, or multiple clean rejections sitting right above my demand zone. When a level looks too obvious for a bounce, it becomes an engineered pool. I know a crowd of traders has placed their orders there, with stop losses sitting right beneath it, thinking it is an unbreakable floor. What I want to see happen is for the price to break below that obvious retail level, sweep all those stop losses, and plunge directly into my underlying demand zone. That institutional sweep gives us our prime buying opportunity because it clears out the weak hands and mitigates the original order block. The exact same logic applies in reverse for a bearish market. I look for an obvious liquidity level sitting just below my supply zone, waiting for the market to sweep upward before rejecting downward. To master this step, I also had to integrate the concept of time and price, specifically looking at session liquidity. Markets don't just engineer liquidity anywhere, they do it based on a daily schedule. During the Asian trading session, volume is typically low, causing the price to drift sideways and build a tight, consolidated range. This range creates highly defined high and low boundaries. When the London session opens, institutional algorithms frequently launch what I call a Judas swing, a deceptive move that violently sweeps the high or low of that overnight Asian range. If I see the London Open sweep the Asian session liquidity directly into a higher time frame demand zone that I previously mapped out, my confidence in the trade doubles. It shows that time and price are aligning perfectly to trap early breakout traders. Executing the trade itself is remarkably stress-free because I don't sit in front of the screen all day waiting for the perfect moment. I heavily rely on setting up limit orders and price alerts on TradingView. I set a buy limit order right at the top edge of my demand zone, place my stop loss slightly below the zone for safety, and set my profit target to at least twice the distance of my risk, or target the previous major highs if I am feeling aggressive. The market does the rest, sweeping the retail liquidity, triggering my entry wick, and reversing toward the target. However, to protect myself from chasing bad setups, I always apply a filter known as premium versus discount pricing. I use the Fibonacci retracement tool on TradingView, but I modify it to only show three key levels: 0%, 50%, and 100%. The 50% line represents the market's equilibrium. If I am looking to buy, I refuse to place an order unless my demand zone sits firmly in the discount territory, which means it is below the 50% level of the entire structural swing. Buying in the premium zone is like buying groceries at retail price. You want to wait for the wholesale discount. Conversely, when I am hunting for short trades, my supply zone must reside in the premium zone, above the 50% equilibrium mark, ensuring I am selling at a premium price. It might sound like a lot of variables to track initially, but it is no different than training your eyes to spot a regular chart pattern. Think about a standard triangle pattern. You aren't looking for a perfectly straight textbook drawing because real market data is messy. Instead, you focus on the underlying rule, converging trend lines. It's the same here. Don't obsess over finding a flawless sequence. Just focus on finding an obvious liquidity pool sitting right next to a fresh supply or demand zone. Let me walk you through how this looks on a short trade. Looking at my watch list, I notice the market is steadily printing lower highs and lower lows, indicating a clear downtrend. I spot a clean break of structure as the price slides below a previous low, and then another break right after it. Following my process, I take the most recent break of structure and look at the origin of that sharp drop to map out my supply zone. Right below that zone, I notice multiple candle wicks rejecting the exact same level, creating an undeniable pool of liquidity. The trap is set. I place a short limit order at the bottom of my supply zone, put my stop loss just above it, and aim for the previous lows. The market drives up, sweeps those retail wicks, taps my supply zone perfectly, and collapses straight into my profit target. Once you get comfortable with these core principles, you can start looking for an advanced variation of the setup that provides incredible precision. The foundations are exactly the same. We start with a break of structure and map out our zones. But the difference lies entirely in how the liquidity is engineered. Instead of a typical double bottom or a line of wicks, the liquidity is actually formed by a minor zone sitting right next to a major zone. I distinguish between the two by looking at the scale of the price swing that followed them. A major zone comes from a massive, highly visible market swing, while a minor zone is born from a small, short-term structural move. The ideal scenario occurs when a minor demand zone forms just above a major demand zone. This is often referred to as inducement. The retail crowd treats that minor zone as strong support, unknowingly building up a massive pile of stop losses right underneath it. That minor zone effectively becomes our liquidity pool, destined to be swept into the major zone, waiting just below. Looking at an uptrend chart example, I see a large price swing that breaks structure, allowing me to draw a solid major demand zone at the base using my TradingView tools. Shortly after, the price makes a smaller, short-term swing and breaks structure again, creating a minor demand zone slightly higher up. I place my limit long order right at the top of the major demand zone. As the trade plays out, the price bounces a few times at the minor zone, luring in eager buyers, before aggressively breaking down to sweep their stops. It taps my major zone flawlessly and reverses violently back up to hit the previous highs for a beautifully clean trade. We can see the exact same mechanics play out when the market is shorting. On this bearish chart, a massive downward swing breaks structure, giving me a clear major supply zone. Just below it, a smaller internal swing creates a minor supply zone. This minor supply zone is our target liquidity level. I place my limit sell order at the bottom of the major supply zone and set my targets. The price drives upward, shows a brief moment of respect to the minor zone to trick casual sellers, and then bursts right through it to capture the liquidity. It triggers my entry at the major zone and immediately drops back down toward the target lows. An essential habit I developed while trading this advanced framework is a strict rule regarding trade management and psychology. When you play with zones this precise, there will be days when the market drives toward your major zone, sweeps the minor zone, and misses your limit entry by a single fraction of a point before skyrocketing to your target. Early in my journey, this used to trigger intense FOMO, the fear of missing out. I would frantically cancel my limit order and buy at the current market price out of sheer frustration, only to watch the market reverse and stop me out. Now, I understand that a missed trade is simply part of the business model. If the algorithm doesn't tap my exact limit line, the trade is dead to me. This professional detachment is what separates consistent traders from gamblers. By protecting your mental capital, you keep your mind sharp for the next clean setup. To truly maximize the power of this strategy, I had to master one final layer of analysis that transformed my chart reading from guesswork into a highly predictable routine. Top-down confluence. Early in my trading journey, I would hunt for 5-minute setups in isolation, completely blind to the larger forces at play. I quickly learned that a lower time frame demand zone, no matter how clean it looks on TradingView, will easily get crushed if the market is currently pulling back into a massive 4-hour supply zone. Now, I never look at a minor time frame without first anchoring myself to the higher time frame narrative. I start my analysis by mapping out the daily or 4-hour structure. If the higher time frame is deeply bearish and dropping toward an unmitigated macro demand zone, I know that any 5-minute long setups are counter-trend and carry higher risk. Conversely, when a lower time frame liquidity sweep aligns perfectly with the direction of the higher time frame order flow, that is when the highest probability trades occur. The higher time frame provides the wind at your back, while the lower time frame gives you the precision weapon to strike with minimal market exposure. This mechanical harmony directly feeds into the most mathematically liberating aspect of this strategy: asymmetric risk-to-reward ratios. When you trade traditional retail patterns, your stop losses are often massive because you are placing them below broad, arbitrary support lines, leading to poor one-to-one risk dynamics. This forces you into a high-stress environment where you must maintain an impossibly high win rate just to break even. However, because this liquidity method allows you to refine your entry to the exact candle body of an institutional zone, your risk parameter is incredibly compact. It is not uncommon for these setups to easily yield 1-to-4 or 1-to-5 risk-to-reward ratios. On my TradingView charts, seeing a setup with a tight stop and a substantial target completely changes your psychological relationship with losing. Suddenly, you realize that you can lose 60% of your trades and still net a beautiful, consistent gain at the end of the month. It completely removes performance anxiety, transforming every loss from a mental failure into a minor, calculated cost of doing business. Mastering this framework completely shifts your perspective. To execute this effectively and build true consistency, you need to rely on precision charting. That is why I do all my heavy lifting on TradingView. I use its advanced charting engine to monitor multiple timeframes simultaneously, tracking how higher timeframe order flow filters down into these lower timeframe setups. By setting up real-time price alerts on TradingView, right at the boundaries of my major supply and demand zones, I ensure that I never miss a liquidity sweep, even when I am away from my desk. It eliminates the emotional stress of overtrading and prevents chasing bad setups, giving you a structured, clear window into how institutional capital operates.